Real estate versus stocks. It's one of the biggest debates in personal finance, and most long-term investment comparisons get it wrong by leaving out critical costs or ignoring the power of leverage. Today, we're running a real side-minus-side 20-year simulation of rental property versus index fund investing using actual formulas from real estate deal analysis. We'll show you exactly when real estate wins, when stocks win, and why the answer might surprise you. Imagine you have $60,000 to invest for long-term wealth building. Option A, you put that $60,000 into a low-cost index fund tracking the broad stock market. Option B, you use that $60,000 as a 20% down payment on a $300,000 rental property, the standard requirement for a non-owner-occupied investment property under conventional financing. Same starting capital, two completely different wealth-building machines. For stocks, we use annualized return, the average yearly growth rate of your investment, expressed as a percentage. Historically, broad U.S. stock market index funds have delivered roughly 7% annualized real returns after inflation over long periods. We'll use that as our benchmark. $60,000 compounding at 7% annually for 20 years equals approximately $232,000. For real estate, we track two things: equity growth from appreciation and mortgage paydown, plus net rental property cash flow, what's left after all expenses. The key formula here is cash-on-cash return, annual net cash flow divided by total cash invested, expressed as a percentage. If your property generates $3,000 in net cash flow per year on a $60,000 investment, your cash-on-cash return is 5%. You buy a $300,000 single-family rental with $60,000 down. Your mortgage on the remaining $240,000 at a 6.75% rate gives you a principal and interest payment of roughly $1,557 per month. You rent the property for $2,200 per month, a realistic rent-to-price ratio in many markets. Now subtract all operating costs. Vacancy reserve at 5% is $110, CapEx reserve at 5% is $110, property management at 9% is $198, plus insurance and property taxes estimated at $350 per month. Total monthly expenses approximately $2,325, meaning your net cash flow is slightly negative at around negative $125 per month. That's negative $1,500 per year, not unusual for a leveraged rental in today's rate environment. But here's where leverage changes the math entirely. If that $300,000 property appreciates at just 3% annually, a conservative inflation-level assumption, after 20 years, it's worth roughly $541,000. Your mortgage balance after 20 years of payments drops to approximately $155,000. That means your equity is $541,000 minus $155,000, roughly $386,000. Subtract the $30,000 in cumulative negative cash flow over 20 years, and your net position is approximately $356,000, compared to stocks at $232,000. Real estate wins by a meaningful margin, primarily because leverage amplified a $300,000 asset using only $60,000 of your money. This simulation assumes consistent tenancy, stable expenses, and steady appreciation, none of which are guaranteed. A major repair, a prolonged vacancy, or a local market downturn can flip these numbers significantly. Stocks, by contrast, are liquid. You can sell in minutes, while real estate can take months to exit and carries transaction costs of 6 to 8%. Stocks also require zero management time, while rentals demand active oversight even with a property manager. And if appreciation stalls, say property values stay flat, stocks likely win over the same period. Real estate wins when leverage, appreciation, and stable cash flow align, but it carries higher complexity, illiquidity, and operational risk. Stocks win when you prioritize simplicity, liquidity, and time, and they remain a powerful long-term wealth builder that no investor should ignore. The smartest investors don't choose one. They understand the mechanics of both, so they can deploy capital where conditions favor them most. If this breakdown helped clarify your thinking, subscribe for more data-driven real estate analysis and like the video so more investors can find it.